Ladies and gentlemen, I want to give you clerical insight into the upcoming trades I'm going to be performing within my $357,000 dividend stock portfolio that by the end of these trades should be annualizing well over $10,000 in dividends. The perspective of these trades comes from optimizing dividend income from a tax-based perspective in my tax-advantaged accounts, and I'm also going to be analyzing the upcoming Canadian real estate investment trust earnings. A lot of them are posting this week, and depending on how that goes during this recessionary period will dictate whether I continue to diversify and add to my real estate investment trust exposure, as I want those higher yields and passive income that if I need to tap into it, I do have that option. Now, if that is a conversation you can appreciate, as we're going to be diving into each one of my brokerage accounts to show you how this shift is going to take place, along with taking the broad view perspective at the end of this video, taking a look at a spreadsheet of the entire holdings. All I ask in return is that you hit that like button. But first and foremost, I did a video yesterday talking about the tax-free savings account, and a lot of you posted some really good questions that I think could be very fruitful to answer. So we're going to go through one of these at a time to see what further insights we can't learn together. Now, Marco asks, I could be mistaken, but I didn't think you could withdraw US dollars from a tax-free savings account. I think you have to convert it back to CAD first. Also, wouldn't it be easier to hold everything in CAD to avoid the currency conversion fees? Thanks. Great info. Congrats on the TFSA returns. That's impressive. First and foremost, you can absolutely, if you have a US dollar savings account and a US dollar trading account within your TFSA, you can pair those dollars and trade them in and out of those accounts and between them and use the US dollar as you please. It's a little confusing, but I always sever up my dollars because, again, I bought Apple purely in US dollars and the capital gains I got from that was insane. And I'm not paying any conversion fees because I'm purely leaving those trades within the US dollar amount. So I'm saving like 1.5%, 2%, whatever they're charging on conversion. Now, Patrick McKinnon says, I really like your approach of asking, how can I get the phone company to pay my bills for me? How much of the stock do I need to own for this to happen? Yeah, that's like early day thinking for me. You look at the hydro bill, you look at the phone bill, you look at car insurance, and then you go look at the companies you're paying and see if they're publicly traded and what the dividends are. And you just ask yourself, how much of those stocks do I have to buy so I never have to pay that bill again? It's a very fun way to start getting into the dividend investing mindset. Though nowadays I like being a little bit more diverse at the scale of my portfolio, which we'll look at in a second. Anger says, great video on the greatness of a TFSA. Do you allocate more growth or more income percentage wise, or do you do 50-50? So back in the day, I was about a 50-50 split between Canadian dividend stocks and US growth stocks with things like Apple and Microsoft. But today my idea of growth is trying to get a doubling out of any of my investments over a 10-year period. So that would be something like VOO, for example. I mean, VOO is primarily a really well diverse growth stock for me. That's kind of my new nuanced perspective, I'm going to say, again, because I'm dealing with much larger dollars. I don't need to get tricky with this with something like a QQQ ETF, or again, be buying Apple and Microsoft and all these stocks individually and try and manage them in and out depending on their earnings and how I feel about the companies moving forward, when I can get an insanely good return from, again, we're in a historical growth market unlike any time in history, and I don't really need much more than a doubling of the market every 10 years to really kind of get myself to $1 million. So I'm really kind of just focused on VOO for growth. And then from the dividend perspective, I still say the same thing. Even though I like dividend income, I don't want to chase super high yield to sacrifice growth of the equity of the stock. So I am looking at things like the Schwab US Dividend ETF, which has had stellar 10-year performance, plus a good 3% yield, something similar to a VYM. I don't want to give up growth for dividends. I think you can get the best of both worlds. You just kind of have to not get too picky and think that you're going to outbeat the game with option ETFs or trying to triple leverage up with a TQQ ETF. But again, that's just the simplified thinking that I have these days. So what else we got? The Noble Lefty says, great video. What do you think about XEI instead of VDY, with XEI being more diversified? So XEI, for those of you that don't know, is basically just a Canadian dividend ETF here that is fixated primarily on just the higher yielders. So it's the iShares S&P TSX Composite High Dividend Index, very similar to the Vanguard FTSE Canadian High Dividend Yield ETF. And this is because XEI does not meet that kind of checklist of not only do I want the dividend income, and I like that these pay monthly, but the stock price, I want it to pretty much double every 10 years. Now, obviously, past performance doesn't equate to future returns, but past performance is all we can base this off of. And unfortunately, XEI, though more diversified, which is probably one of the downfalls, since more than a decade ago has only had a stock growth of 26.5% 0.47%, whereas VDY is up 73.06%. You tap on the 3% yield with VDY, and you're talking about over 100% return in a decade. So there's your doubling. You're not really getting that with XEI, and that's primarily because of the lack of concentration. Now, the US markets grow a lot better than the Canadian markets, so having concentration in smaller markets tends to yield better results. So with XEI, you can see we've got Royal Bank, the largest company in Canada, being at 5%, Enbridge at 5.11%. They have BCE, Bank of Nova Scotia, Toronto Dominion Bank, with nothing making up more than 5%. And you'll also notice that VDY basically follows the typical Vanguard, let's weight it by market cap perspective, because we can see the largest holdings in VDY tend to actually follow the largest dividend holdings of the Canadian compass at the S&P TSX by market cap weighting, because Royal Bank, the largest company in Canada, next to Toronto Dominion Bank. You can see Enbridge in here, followed by like Scotiabank, BMO, Canadian Natural Resources, which again follows very in line with the exact holdings here. And I also like VDY because it's very similar to VCE, which represents the Canadian index, which is those top 60 companies. And you'll see that the performance is almost exactly the same, but one of them, because again, most of the Canadian stocks pay really high yields. So you can kind of get a higher dividend yield without actually chasing the general broader index, right? So you get very similar performance, a little bit of a higher yield. I love my Canadian stocks, but that's kind of my perspective on why I won't own XEI. But let's say I was worth tens of millions of dollars. Yes, maybe I don't care as much about growth and I just want more stability in the income. So maybe I'd go XEI. But for now, I really love my VDY. Anyways, moving beyond that, let's get into my accounts specifically here, guys, and talk about what I'm doing. So I really talked about my TFSA yesterday, and we can see what I plan on doing in here, because unfortunately with a tax-free savings account, any of my US dividends get a withholding tax of 15%. That absolutely sucks. So I realize it's not very optimal to have VYM in here being a high-yielding US dividend ETF. So what I'm going to be doing is selling this off, converting a bit of it over to VOO, and taking the rest of it and dumping it into VDY. From there, a lot of this has to do with my registered retirement savings plan, because the RRSP completely waives the foreign withholding tax. So I'm not paying any 15% withholding, which is going to allow this to compound a lot better over time. So what I'm going to be doing is basically selling out of my VOO in here, again, replacing it with the VYM that I currently hold in the TFSA. And I'm actually going to sell a little bit more VYM in here, and I'm going to divvy it between SCHD along with VYM. So I'm trying to get about, 30,000 CAD between these. So the total CAD account value in here is 61,328. That way it'll be most optimal for dividends, because obviously VOO is more growth-based perspective, and with the 1.6% dividend yield it currently offers, I'm not really getting hindered too hard from that 15% withholding, because if we look at my TFSA income, I'm getting about $1,804 US, but again, that's not very optimal if I'm going to be losing 15% of it. So we'll more or less fixate on the growth side for the TFSA with the S&P 500 index, and then again, get that Canadian income a little higher with VDY, because that is 100% tax-free that I can draw against at any point in given time. So again, when we come into the RRSP, guys, I just want more optimal dividend income from the US side of the border, and I'll use the TFSA for a more growth-based perspective with VOO. And that'll also bump the dividends a little bit in the RRSP, which I'm currently making about $1,312 between these two stocks, but that'll go a little higher as we get rid of VOO in this account. So talking about my managed account, where I'm trying to build out a real estate investment trust portfolio, I am looking at getting rid of VDY, really dependent on what happens with the Canadian real estate investment trust earnings, because I love RioCan, I love Smart Centers, and I have been eyeballing a ton of other REITs, looking at all the industrial REITs, Allied Properties, H&R. I mean, the list is truly endless. The way I find this list of stocks is I basically just come into any basically real estate investment trust ETF. I find like 4 or 5 of them, and I scan through what the top holded REITs are with Canadian Apartment Properties, Granite Real Estate, there's Allied Properties, Smart Centers, Northwest Health Properties, and I kind of pick the ones that have the highest yields, and I just want to see how they perform through this recessionary period from a rental income standpoint, because I have a prediction that because basically real estate value is correcting by upwards of 20%, we're seeing the demand shift to the rental market, and rental prices are up 20% year over year. Therefore, I'm thinking because most of these REITs are rental income based, a lot of them should actually see an inkling in that actual cash flow is what I'm hoping, which should lead to stabilized dividend performance, even though the asset value may be decreasing. So if that works out that way, I am looking primarily at adding with RioCan, Smart Centers, selling down VDY. I want to add Northwest Health Properties. It's kind of the first one on my list here because I really like the super high yield, but I have to be a little cautious because this Northwest Health Property REIT is globally diversified. I think more than 50% of their operations may be outside of Canada, which could lead to a little less tax efficiency because typically to get full tax efficiency, the company has to be operating 50% of its income within Canada. But again, with a 6.14% yield, it gives some optimal room. So if you do end up paying a little more in tax, you're still bringing in a super high yield. I'm also looking at Canadian Apartment Properties REIT because this is the largest Canadian REIT, has had great performance. I've held it in the past. It's a little sketched out by the current performance here. So I just want to see how the underlying fundamentals pull up in the next coming earnings, which I think are August 11th. Most of these are posting this week. And then finally, I do like the logistic REITs. I am looking at Granite Real Estate Investment Trust, Summit Industrial, Dream Industrial. I'm just kind of analyzing all of those because they've had the best performance over the last 10 years. But at the same time, I just don't know what's happening with logistic centers, with Amazon canceling a bunch. You just don't know. So let earnings kind of bake in. Let's get a little bit more comfort from the numbers, and then we'll decide what we're going to do here. And the only reason I would not buy an ETF over the individual REITs is because REITs are already like diversified ETFs, and they charge a high management fee on REIT ETFs, upwards of 0.5 to 1% or more sometimes. And I just feel like even buying one of these REITs is a super diversified portfolio. The risk just comes into management and making sure management doesn't screw it up. So this hasn't happened yet, but from an adjusted standpoint, this is how I think the in general portfolio will look when I'm done. Again, 357,000 divvied up between these stocks. We'll see that over 50% of the portfolio will be the total portfolio, including my corporate account, which I'm not really talking about here, which just holds VDY and VOO. And I still think I've got but my Google shares in there, but not really adjusted on here. But 50% of my portfolio combined will be in US stocks. So that way I think there's more growth out of the US. So having a 50% optimal US exposed portfolio, probably smart. We're going to have about 30% of the portfolio in VDY and about another 10 to 12% within individual real estate investment trust, excluding Bitcoin, Google, some of my private placements and stuff like that. Now, from an income perspective, we can see the Canadian economy is where most of my income will be coming from, which will be a lot more intelligent because, again, Canadian economy yields a lot more. And it's tax efficient much better if I want to tap into it or reinvest the dividends. So it's nice that it's optimized that way. And then again, we can see 20% pretty much coming from VOO, and then about 10% each coming from VYM and SCHD. So that would be in about 30%, 40% of the entire portfolio will be yielding income from the US border, which is great because I travel to the US. I like having that exposure to US dollar, but again, mostly growth oriented, right? Because, I would say SCHD and VOO, I would optimize as more of a growth based income perspective rather than a dividend income perspective. But nonetheless, that's just my take on the entire portfolio here, guys. This should yield up to about $10,337, excluding some of those tax inefficiencies. I don't know exactly what that would come down to, but again, it's all just looking at balance and scale while also realizing that I do want to get to a place of early retirement. And at the scale of a 357k portfolio, maybe we'll just run a bit of math for fun here, taking a look at the compound calculator, because I think this is really going to help figure out where you are and where you should be investing moving forward. Because again, as your portfolio scales, you do not need to take on as much risk, especially in these volatile markets, to get to a place of early retirement. So to put this in perspective, if I have a $357,000 stock portfolio and my annual additions, let's say I want to keep it at about $1,000 a month because that's historic. I do a lot more than that, but I'd always like to keep it at least double the minimum. They say invest at least $500 a month, but double that if you want to try and fast track retirement. Years to grow, let's say, I don't want to be working much beyond 45. I'm 30 years old today. And let's say I'm going to get the dead minimum average rate of return. So let's say with the dividend, I'm getting maybe 8% just to really lowball this, just to be safe. And that's going to leave me with about $1.48 million, which is pretty wonderful, but you can play with the numbers. Let's say we see the S&P outperform. Let's say we see a continued outperformance in SCHD and a doubling in VYM, and same with the VDY. All in all, guys, that should get me closer to maybe $2 million. But a lot of this is going to be dependent on, again, if I add more money to the portfolio, if I add less. But this is going to carry me into an early retirement, which is why you can see I'm not really chasing individual stocks like Apple or Microsoft anymore, because obviously if you wanted to get crazy outsized returns and you can even yield 12 12% on a portfolio like this, I mean, you could easily end up with $2.5–3 million in 10 to 15 year time frames. So you can really see how the scale of large numbers can really change the perspective outcome of the risk you need to take within a portfolio, guys. And again, just from an optimization standpoint, I really think shifting VYM from my TFSA to my RRSP and diversifying a little farther with SCHD, which I think is a wonderful dividend ETF to offer further diversification, because a lot of these dividend ETFs are highly financial focused, and I feel like SCHD is a little bit more diversified into healthcare and tech, so it should continue to just build out my sector diversification a little better as well. But at this point, I'll pass the question off to you. This has been a very entertaining video. I hope you guys learned a lot from it, and I'd love to know what you think in that comment section below. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.